Hi, and welcome to the 8th edition of our Investment Insights series, Magellan Minutes. My name is Felicity Haynes, Head of Retail with Magellan Distribution, and today I'm joined by Jack McManus, an investment analyst. Thanks for joining us, Jack.
Thanks for having me, Flick.
Now, the arrival of the pandemic seemed to really accelerate home shopping and delivery. Now that we're post-pandemic, can you just talk a little bit about how that trend is looking now?
Yep, so the acceleration in e-commerce growth through 2020 was one of the biggest consumer trends that we saw at that time. So when the world bunkered down and we either couldn't or didn't want to interact with each other, we were forced to buy more of our stuff online almost overnight. Likewise, the businesses that we bought them from were forced to invest in their digital capabilities just to stay in the game. And what resulted was a huge spike in e-commerce penetration, or the percentage of sales done online. So just prior to the pandemic, in the US that sat at around 16%, and it had increased at a fairly steady pace of 1% per year. Now what we saw when COVID hit is that spiked to 22%, effectively accelerating that prior trend by about 5 years in a matter of months. Now we and other observers at the time, we thought that was the new normal, that e-commerce penetration would just go higher from there. But what we actually saw was a period of reversion as the lockdowns ended and people went and shopped in person again. Then we saw a period of consolidation where it essentially went sideways for a couple of years. Today, we're pretty much back on that old trend line where we would have been without the pandemic, and e-commerce penetration is sort of increasing at that steady pace again from here.
Amazon is one of the stocks that you cover. How did they manage to grow and respond to market demands? And are there any other competitors also having success in this sector?
Yeah, so Amazon have their own vertically integrated fulfillment network, distribution network, and last mile delivery logistics network. And so that means that in many respects, they're self-reliant. They don't rely on the success or failures of third parties. So that meant that going into the pandemic, they were very well positioned to react and adapt to the changing environment quite quickly. They invested heavily to increase capacity and meet the demand. Effectively, they doubled their infrastructure footprint in about 18 months. And they built out a vast delivery network. Today, they're delivering more packages in the US than the national sort of giants like UPS and FedEx. And they're delivering those goods faster than ever, which is helping them sort of increase market share in those more time-sensitive, everyday essential categories like toothpaste and deodorant. The other player we're seeing gain a lot of share is Walmart. So they invested heavily in what they call BOPIS, or buy online, pick up in store. And they're increasingly automating their supply chain, so they're getting very efficient at doing that. And that's helping them gain share in online grocery. So it's really those two players that we're seeing get the lion's share of growth in that market.
Amazon are known for their entrepreneurial culture. Where do you see the opportunities for them to continue to grow? They seem like they're already across so many different industries. Is there anything they can't do?
Yeah, they are an entrepreneurial culture. They like to characterize themselves as the world's largest startup. In some respects, that's true. They do have this very entrepreneurial culture, which emphasizes invention and experimentation. There's concepts like agility and flexibility sort of codified in the company's principles, and you can see it in how the teams are structured and how they operate. But at the same time, they're really, really big. So there's only so many markets out there that are worthwhile for them to pursue, or ventures that will actually move the needle. A few of their sort of bigger ones that we're keeping an eye on in advertising. They're still growing very strongly in digital advertising. And that's not just only via the sponsored ads on their marketplace, but they're increasingly leveraging their popular streaming service, Prime Video. In healthcare, we're sort of seeing them put together a sort of patchwork of a service there mainly via acquisition, but also organically. And then in logistics, that they're increasingly leaning into that. And we expect that they'll basically externalize the capabilities that they've already built for themselves to third parties. Aside from that, there's other experimental moonshots, in satellite internet, driverless car, robotics, just to name a few. Some of those will be successful, but many will not. I often see press articles, where they're talking about something that didn't work or that Amazon shut down, and they're painting the company in a sort of negative light. But I actually think that's sort of proof of a positive entrepreneurial culture and action. Just for one example, they were famously lampooned for their attempt to launch a phone in 2014, the Fire phone. And look, it wasn't a good phone, but they shut it down quite quickly, which I think shows that sort of capital allocation discipline. And then the lessons they learned along the way from that saga were used to launch subsequent successful devices like the Alexa and Echo speakers and the Fire tablet. So it wasn't a lost effort.
Yeah, I haven't heard of the Fire phone, but certainly Alexa's very much a household name now.
Yeah.
So why do we like it for the fund?
Yeah, look, there's clearly lots to like here, but I'll just give you a quick elevator pitch. So the investment thesis for Amazon's premised on 4 key pillars. So firstly, they're a dominant leader in multiple large, attractive and growing end markets, the largest ones being e-commerce and cloud computing. Secondly, they benefit from a combination of multiple strong sort of self-reinforcing competitive advantages, economies of scale, branding, network effects and culture. And this gives us some confidence that they'll at least be able to maintain their market positioning and probably improve that over time. Thirdly, we think profitability is going to improve significantly over the medium term. There's 2 things going on there. So one is we think they'll get operating leverage as they grow into the infrastructure that they've built out in the retail business. And then secondly, and probably more prominently, is just the positive business mix that we're seeing. So the higher margin businesses in AWS, advertising, and the marketplace are growing the fastest. So over time, they should become a bigger part of the pie, and we should see profitability overall improve. Fourthly, we like the optionality that's inherent in this business. So they, as talked about before, there's an entrepreneurial culture, and they have a good track record of entering and winning in new markets, and we expect that to continue in the future. It's hard to put a quantitative estimate on the value of something like that, but we think it provides upside and sort of skews the range of outcomes in our favor. So they're the 4 pillars. And then I'd just say on valuation, it's been on a strong run over the past year. It's almost up 70%, but we still think it is attractively valued, and it should deliver double-digit returns over the next 3 to 5 years.
Thanks, Jack.
Thanks, Lee.
And thanks for joining us today. If you have any further questions, please reach out to the Magellan distribution team, and please feel free to share this video with any colleagues and clients.